it's pretty rare. It does happen, but these circumstances end up being pretty short lived, and there'll be some correction, I think, pretty quickly into the spring of 23.
Chris, you want to talk about the Fed funds and some of the adjustments the Fed's made?
Yeah, and we are about a month out from the last meeting of 2022. I think it's December 14th is when they'll announce the next move and whatever it'll be for Fed funds. But we're in the range right now of 3.75 to 4%, which is their the federal funds reserve rate range. And we still think that there's probably going to be a 50 basis point or so raise here at the end of the year, which would put it right to, again, where they've provided guidance before, right around 4.25 to 4.5%. And according to what we sort of gathered from a couple different sources, there's an 80% chance of that being a 50 basis point move at the end of 22. And then, I mean, again, there'll be more guidance that'll come out of that. We'll probably have a fair amount of market volatility around some of those comments, but we would expect the yield curve, so the difference between short-term interest rates and long-term interest rates, we'd expect that to be inverted here going into the end of the year, meaning short-term rates, 1 and 2 year treasuries, are actually going to be yielding more than 10 or even 30-year treasuries. So that's pretty, it's pretty rare. It does happen, but these circumstances end up being pretty short-lived, and there'll be some correction, I think, pretty quickly into the spring of 23.
Yeah, just to give you some color on where we were at with again, treasuries being sort of the de facto benchmark. The 10-year started at 175 this year, in 2022, and we got up to a high of 422 in October, and we're about at the 380 right now, 3.8%. The 2-year, on the other hand, is a bigger story. Started at 80 basis points. Mm-hmm. So that's your short-term rate. That's your cash rate. Everything drives off these short-term rates. So if you were in cash and money market, you probably weren't making anything at the beginning of the year. 2 years at 80 basis points. It got up to a high of 5.13% on November 2nd. It is down slightly since then with some data we've already discussed coming in, inflation numbers coming down, but it's still at 4.37. So you got, like Chris just mentioned, you got the 2-year at 4.37, you got the 10-year at 3.8 right now, and so you got the 2-year actually yielding more than a 10-year bond.
Well, and I think we've hinted at in the past and recently here that for the first time in a long time, investors with cash or money on the sidelines that have been looking for interest or a safe place to park money that essentially grows a little bit. We're finally starting to see that. I mean, I know a lot of us have been having conversations with clients in cash on the sidelines, and our money market rates are now right around 3.77%. I've had a couple clients recently look into CDs, and you're starting to get paid 4% on short duration CDs. So that is the one benefit. Even our short duration bonds now are starting to, like you said, go up with the yield on those and be paid to hold those a little bit for us. So